Another big factor is when they state, what percentage of, what stocks are going to stay within that one standard deviation. These historical results are usually overstated, meaning that if you trade within that one standard deviation range and it says 68% are going to be within that range, it's actually higher than that, because historical implied volatility is almost always overstated. So that's a thing that we can use to our advantage. And there are some various, like SPY, 87% overstated. Gold was 79%, Apple 70%. So almost in all instruments, the range is overstated. So that means that the stocks generally don't move as much as the implied volatility indicates. And the other kind of really important factor is that implied volatility always reverts back to its mean. It's a mean reverting measurement. So remember, we talked about the lull, the expansion, and the contraction. Well, the contraction is the reversion to the mean. And probably the easiest way, or the most dynamic way to see that, is if you ever trade earnings, or just look at an earnings trade, and you can see the day before they announce earnings, you can see some sky high implied volatility. And if you just look at the end of the day, the next day, it could be half of that in one day. So that's kind of an implied volatility crush. And the really good thing about volatility, if we're selling credit spreads or selling calls or selling put spreads, what happens is if the volatility reverts back to the mean, that makes the option price cheaper, meaning we make money just because of the IV reversion. Sorry. Does that make sense? So I've seen cases where a stock price really hasn't moved at all, but the IV reverts back to the mean and you hit your price targets. And remember, IV usually goes up when a stock sees an unexpected downturn. So that's why we're seeing IV now super high on every instrument.